Would you like to invest in the property market but feel like you've been priced out? By the end of this episode, you will know what property crowdfunding is, where to gain access to the property crowdfunding market, how to invest and profit in stable and volatile markets, also why property crowdfunding is so revolutionary. For handy personal finance tips and useful information, hit the bell to be notified for our latest videos. I'm Dwayne, the finance strategist who has built an economic base from a grassroots level. My aim is to share my knowledge for you guys to prosper and build wealth. What is property crowdfunding? Property crowdfunding is when a group of people put their money together to buy a property. There are two forms of property crowdfunding. One is the buy-to-let property model, whereby the property is bought and rented out to tenants, and that rental income minus expenses is split between a group of investors, and that split is in proportion to the amount that they've invested. For example, if you was to invest 10% of the property's price, then you would receive 10% from the rental income. If the property was sold, then you would receive 10% in the share capital. Number two is the development model, whereby the money goes to the property developers in the form of a loan. And when that property is developed and sold, the profits of that property you will receive in proportion to the amount that you've invested. For example, if you invested 10% into the loan to the developers, when that property is sold, you will receive 10% of the profits. This is a higher risk, higher reward type of investment, which is usually between 1 to 2 years. Where to get access to the property crowdfunding market? There are online platforms that facilitate this process for you, giving you passive income and equity. Websites such as YouOwn that will find the property. As a parent company, they set up a holding company for the investment property, and that's called an SPV, which stands for Special Purpose Vehicle. They buy the property in the name of the SPV. Reason being is that in the UK, you can only have 4 names on the title deed of a property. However, with an SPV, you can have many shareholders, and that's where you come into play and become a shareholder of the SPV. Also, the SPV is a separate entity from the parent company you invested in. What this means is, if the parent company was to go bankrupt, you would be protected. If this was to happen, the parent company would have to forfeit its role as a managing member of the SPV to another investor in the portfolio. The good thing about these type of platforms is they do all the work, making your investment passive. If there's any maintenance works to be done, they will handle it. If there's any rental queries, they handle it. If you want to come out of your investment, they facilitate the process. Do you believe investing has become more available to everyone due to technology? Put your answers in the comments below. How to invest and benefit in stable and volatile markets. This can be achieved by using the same amount of money you was going to invest in one property and dividing it into multiple properties, giving you immediate diversification. So, if you use this as your strategy, you've protected yourself when there's a down market because you're also invested in a stable market. Plus, you'll receive the benefits of a volatile market because when the market is up, you're up. The idea is to limit your exposure to risks while accessing the benefits of the riskier markets, and that's what you're getting by applying this strategy. Also, this can be your way of building a long-term and short-term investment portfolio for yourself. Also, because you've invested in a crowdfunding structure, it's a lot faster for you to get your money out of the investment than it would be if you was to try and sell a property the conventional way. Why property crowdfunding is so revolutionary. The low barrier of price entry into the property market, which is generally a stable asset class gives you the opportunity of getting onto the housing ladder, generating wealth, and building a legacy. And all that from the structure of property crowdfunding, which is a business model that opens doors to financial opportunities that can change the financial circumstances of you and your family within one generation. And the term for this is known as financial inclusion. Property crowdfunding is an alternative way of purchasing a buy-to-let property. However, you don't have the responsibility of maintenance, tenants, insurances and such, but you receive the financial benefits of a landlord. One of the powers of property crowdfunding is that it's part of the fintech revolution, or I should say financial technology revolution, that is taking over all sectors. People nowadays, especially millennials, want on-the-go access and flexibility with their financial products, and property crowdfunding falls right into that category. Now that you have another investment option to explore, why not check out my previous 2 episodes on my Investing 101 series? Also, check out my credit card and budgeting 101 series. If you enjoyed this episode and found this helpful, click the like button, comment and subscribe.